In this video, you're going to learn how I research the companies that I include in my Freetrade dividend growth portfolio and on my watch list. Disclaimer, I'm not a financial advisor. If you seek financial advice, please see a licensed professional. As a UK investor, I start by casually looking at dividend data. This website allows me to just simply scroll through their website and see basic dividend yields, whether they've announced that they're cutting it or suspending it, what the current yield is, and what their dividend paying history is. So I just look through this, I click by sector, it allows me to specify by market, and typically I invest in the FTSE 100 or the FTSE 250, and that's where I'll look at companies, maybe, I hadn't heard of Reckitt Benckiser before. I'd click into that and I'd start doing research on the company. It's very random evaluations. I haven't picked and chose except for sectors. I looked for my basic diversification and then chose my favorite from each sector. So I'd usually click the dividend yield button at the top of the web page, and then I'd sort by sector on the drop down menu. If you click that, and then it will allow me to just get a simple grasp of all of the companies in either the FTSE 100 or the 250 and what they do. So am I interested in aerospace and defence, or am I interested in life insurance? Am I interested in investment trusts, for instance? So it just gives me a quick, brief overview that I can see. So it can get confusing for a new investor, but it's there just for simple sakes. You can have a look, and it's very, very simple of a site, so you can have a quick look through it and see what you want. And this is great for people as it's a free website. I haven't seen of any sign up. So I'll have a look through the website, I'll scroll down a bit, I'll see dividend paying history, and I think, look, there we are, Diageo. So if I'm interested in Diageo, I'll click the little arrow on the right of the row. There'll be a little arrow, you click that, and now it will show me the dividend yield. It will show me their payouts in the last year, how much they were individually, what the overall dividend yield is, and what the yield has been over the last few years. This is basic information. I can get a good sense of how it works. I want to know, has this dividend been at this price? Is it a good price for its current value? Is the yield in a good position? Or has it spiked up rapidly and become unstable? So typically I try to look for a high as dividend frequency as possible. Dividend frequency is simply how many times they pay a dividend each year. Typically in America, such as the S&P 500 constituents, they would at least pay quarterly. However, in England, there's different laws. I believe that they only need to provide updates biannually. So typically a lot of the older companies have got biannual dividends. So typically I look for at least biannual, but I try to go for quarterly if possible. I want the highest dividend frequency so that I can get as much cash into my account as possible and compound it more and more. So on a maximum history, if you click maximum history on the dividend yield graph of Diageo, you can see that it's been downtrending. So what does this mean? Well, it means that they've been growing more than they've been increasing their dividend. So typically you might want to look at the share price more. Has this company been performing better with capital growth than keeping up their dividends? And yes, they have. Their dividend is still quite nice. It's relatively weak of around 2.6%, but it's still good. It's better than inflation, and it's got capital growth. So you can see it downtrending, and the pattern would likely to continue, but you can see how it's suddenly ramped up again. That means it's gained more value. The dividend yield is higher, so the share price is lower. And I can look back on the graph and I can see in the last 3 years, it hasn't even gone that low. So this is about 3 years back in time I could go and purchase this share. I like to look at the time as a perspective more than money, because if I think, if I could have bought Bitcoin in 2007 when it was like 50 pence a coin, and then sold it at some point in like 2017 when it was like 11 grand, I believe. You see the time bonuses of it. If you'd have got it early, you would have made more money. So I like to see it like that. But this isn't enough information, and I want to see more of a detailed history of their payouts and whether they've been continually growing their dividends. So now I'll go on to Seeking Alpha. And you got to be careful. You have to use multiple sites. If you only use one site, there could be errors or inaccuracies in the information. So using multiple sites is the best way to make sure you can get the correct information. Interestingly, I cannot find the London Stock Exchange for Diageo on Seeking Alpha, so I will look at the New York Stock Exchange. But do bear this in mind. This could mean that there will be differences in the data. However, I'm just looking for a general trend. So you go on to Seeking Alpha, you search NYSE : and then you put DGE. You click that and that'll be Diageo, or you could probably just search Diageo and you want to click on the dividend tab. And we are presented with a lot of information which may be overwhelming at first. Take a breath and have a look. So you'll see the basic dividend yield, which we've seen earlier, we know that. But what we want to look at is the payout ratio. And this is how much of the company's yearly profits go into their dividend payout. And you may think the higher, the better, right? That means more money for you. Sure, you would get more money, but it means they've got less room to grow their dividend. And I look for dividend growth. If you wanted a high dividend already, then sure, that would apply. But typically, I want to see a payout ratio of less than 60%, as this shows in the future they've got time to develop and grow their dividend, as well as have more money to reinvest into the growth of their company. This is different for REITs. I'm not going to explain it in this video, but they will typically have a high payout ratio, and that's a good thing. That's for tax exemptions. So we can see that the current payout ratio is 69%, which means 69% of their overall profits are going into their dividend payment, which is quite high. It does mean that there's a higher risk associated with it. However, you need to look at the importance of the website. This could be different as it's the American version. So I'm going to ignore that for the time being. I'm going to look at the dividend history, and you can see it's quite inconsistent. Again, I believe this is due to the valuation of the pound changing, and therefore the dollar amount is fluctuating. It's nice to look at, and you can see that they've consistently paid their dividend, but I don't trust this website for the time being. At least with this company, I'm going to write it off a bit. There's still some useful information on here, but I'm going to look to other sites. But what it is worth considering is on this history tab, you can see that they've continued paying between the dot-com bubble, and you can see that the Great Recession of 2008, that they continue to pay their dividend. So those are the things I look out for. If there's been a recession, have they still paid the dividend? And they have. But I want to look more at dividend growth now. So now this is the importance of having a second website. I'll go back to dividend data and I'll check. Okay, so I'll look at the dividend history tab and I'll look for Diageo. And I can see which companies have had continuous dividend payments over the history. And you can see that Diageo is near the top. They've been paying for more than 20 years. So I'm going to click further and see what it says. Has it paid continuously? Yes. Has the dividend been grown or held? It's been grown. It hasn't stayed the same, meaning they've continuously year on year grown the payment. How many years has the dividend been grown? 20 plus. Dividend data, I don't think they go much further than 20 years, but I am happy with that. I don't really need to know much longer than 20 years, as it will sort of give me more of a bias. If I know that one company's been paying it for 67 years, but the other's only been going for 38, I'm going to have more of a bias to the one with the longer dividend paying history. And as you know, that might not always work out with Shell's recent dividend cut. But this is good. You can see that it's grown over the last 20 years, which means in a recession, it's likely to be paid. So now I'll click the little arrow on the Diageo again on the right side, and now it will show me the dates, and it will go back to 2000, which isn't a long history to look at, but it's enough for me to get a basic grasp. And scrolling down, I can see the compound annual growth rate of the dividend. And Diageo seems to be increasing their dividend by about 5 to 6% each year, which is, I mean, sure, it's lower than some companies, but that's high and consistent. That's more than nearly triple the rate of inflation each year on year. So it's certainly a good dividend payer. Dividend I receive, I'll reinvest, and then that'll grow even further with the capital growth and the dividend payment. And then you can see with Diageo that there will be a lot of compounding. So this would be an idea of a good dividend growth company. However, let's look further into it because we've only really seen more about the dividend. If you've enjoyed the video so far, please consider subscribing for more investing and finance content. But I'm not finished there. You may think, what else would I need to look at? The dividend has been continuously growing, right? But that's it. I've found the information. It's a great dividend company and the yield is great compared to recent years, so why not buy now? Well, now this is where I like to take a look at the company's health, typically their balance sheet, how their board are reacting to certain situations, and a brief look at recent news. And the easiest way for a new investor to do that is Simply Wall Street. On Simply Wall Street, I simply signed up, I didn't mean to make the pun, I signed up with a free account and I'm on the trial plan. That trial plan then expired and I'm just a free user, which means you can access 10 detailed reports of a company, of different companies each month. So then I search for LSE: DGE, which is London Stock Exchange Diageo. Now I'm showing the summary page and it reads that Diageo PLC, together with its subsidiaries, produces, markets and sells alcohol or beverages worldwide. Now this is where you ask yourself on your own beliefs. Do I see the demand for alcohol increasing in the next 20, 30 years? Well, yes. Typically this company owns a lot more spirits than it does drafts. They do have Guinness, however. And from working previously in a bar, I've seen a more common trend of younger people drinking spirits and a lot more people drinking than I had a few years back. And there's certainly a trend going on. You can see that some of the pubs in the UK are getting more busier. Maybe less of the local pubs, more of the mainstream branded pubs. They're pretty much a staple in every town. And I think that as the overall age of the population increases, which it is, there'll be a higher demand for alcohol because more people will be legally allowed to drink it. And therefore, Diageo will increase their profits and revenue. And already some of the drinks that they sell are popular. Previous research would be, I've gone onto their website and I've looked at their brands. It's a common thing that these bigger companies do. I've seen Captain Morgan's, I've seen Gordon's Gin, and I've seen Tanqueray. These are very high selling drinks in bars. Like, these are some of the more popular drinks. Captain Morgan's typically because it's cheaper and it's a rum. A lot of the younger people drink it. Gordon's Gin is more for the middle-aged. I've seen that the demand for that is usually quite high. It's usually a house gin in a lot of bars. Tanqueray is a more posh experience, but it's drank more by the elderly, and there's a high demand for all three of these drinks as a whole. And typically in the UK, it's probably one of the best ways to socialise. So I take a brief view by scrolling down at its share price in recent history. I just want to see, has it gained much? Or has it been stagnant? Or has it even been downtrending like companies such as BT? And you can see this company has grown quite well. It's not incredible, it's not like Tesla, it's not just suddenly spiked up, but you can see it's been pretty consistent throughout the years, which makes it quite a staple and more of a defensive option to have. And at the moment it's trading about £8 less than its all-time high, which I consider a lot of value. Maybe the all-time high isn't fair price, but people were buying it at that point in time. So I do see that it has some value to be taken. I have a quick look at the volatility. Beta volatility is basically how volatile is it compared to the market. One being it's as volatile as the market, more than one being it's extremely volatile or will drop further than the market but go higher than the market. Diageo is lower, which means that the market will drop, it won't drop as much. But that doesn't mean it won't necessarily grow further than the market, because at the end of the day it's each individual company and how they perform. I think they're lower volatility but more likely to outgrow the market. But this perhaps isn't great if you're looking for an extremely high value company, as DGE is quite defensive and you're not really going to get a great price on it. So if you look at shareholders' returns, you can see how much capital growth the company has had with their share price over the last 5 years. And in the last 5 years, they've outperformed the market by 70%, which is incredible. Mind you, the FTSE 100 hasn't performed very well with the whole Brexit situation. Now the current pandemic situation, of course, it's going to be falling. And in the last 5 years, the FTSE 100 has fallen about 18%. But it has outperformed the overall market and its industry. And there's something to look for. It's outperformed by 70%. Maybe it won't consistently do that, but it is good. With dividends reinvested, the FTSE 100 typically has a higher average dividend yield than Diageo, so that's where the gap starts to close slightly, but you are making a bigger gain with the dividends as well with Diageo. My goal is to outperform the market, so if I see a history of a company outperforming the market, then I'll look for them, because I think if they've done it in the past, they can achieve it in the future. They might not necessarily achieve it, but they can. So you'll notice if you scroll down further, share price versus fair value. It's based on some analytic calculations, and take it with a grain of salt because we never truly know the fair price of a company. However, it is great to look at for a second. Oh look, it's undervalued by 2%. Not great, but it says something. If you see a company that's undervalued by 40%, maybe you'll think, wow, it looks like better value to at least this website. Take it with a grain of salt. Don't really trust it, but it's nice to look at. Now, the price to earnings ratio is really, really, really important to look at, so make sure you do check it. You typically want the price to earnings to be lower than that of the industry and the market, and Diageo doesn't have that. It's not really a game changer, but it does mean that you are paying more of a premium for the company. But then you can also see that the industry seems to be more premium, as the industry as a whole has a higher price to earnings than the market. But you can see that Diageo is a more premium member in this industry. Yes, you will be paying more for the actual earnings of each individual share, but that doesn't necessarily mean it's worthless. It just means that perhaps it's a bit overvalued. But then you might also realize this is of higher value because of its continuous dividend growth and its capital growth. Now, I typically try to avoid looking at the forecast annual earnings growth because Again, it's just predictions, but it is a good indicator of whether analysts think the company is going to earn or lose money. It's just basic, right? And in the future, it looks like they will earn money, which great, right? You just tick it off and just think, right, they're predicted to earn money, so obviously they're not running at a loss. It's just a quick basic insight, so you just have a little bit more of an understanding, and typically you don't really want to be buying a company that's earning a loss, but they have predicted it to be higher than the industry. It might mean that this company is better to buy than the rest. Now, scrolling down, looking at the financial health of the company, I do like to look at the balance sheet, and this website displays it very, very simply. Again, excuse the pun. If you've enjoyed the video so far, please hit the subscribe button. It means a lot. You can clearly see that their short-term assets are larger than their short-term liabilities, which is good. It means if needed, they can pay off their debts in the short term. However, their longer term assets will be things like their factories, their buildings, things that they don't necessarily want to sell. So they don't really want to liquidate their long-term assets. So they want to use short-term assets to pay down their liabilities. So you can see that they have more long-term assets than liabilities, but you want to see more short-term assets than long-term liabilities. So this means they're able to pay it down without having to liquidate some of their more important assets. And this suggests that they will continue to be in debt for the foreseeable future, which isn't a bad thing. It just means they're leveraging money. This graph also shows whether the company has been reducing their debt. And actually over the last few years, they were reducing their debt and then they suddenly started to increase it again, which isn't great to hear. It means the company is perhaps over leveraged and may suffer if they're unable to pay down their debts. And now they have a higher debt to equity ratio. So they have more debt than equity itself. It really isn't a good thing to see, but as long as the company is consistent, has a high cash position, then it isn't too much to worry about. But it is worth bearing in mind, they may be more affected by a loss in revenue, for instance, and now it's considered quite risky. Now, looking at a dividend, you'll notice that the current payout ratio is different to that of Seeking Alpha. See, this is the importance of researching on different websites. Seeking Alpha said 69%, now it says 54%. Because this is the London Stock Exchange version, I'm more inclined to believe this one. I'm going to actually listen to the data on Simply Wall Street. If I wanted to do more research into it, I would look onto another website and confirm this. However, I'm going to trust it. At the moment in my mind, it's going to be in the middle of it, 69%, 54. So we're looking at about 61.5 or something. So that's roughly their payout ratio if we average it in, which is better. It's an improvement, right? They're saying it's lower. And over the next few years, supposedly they're planning to reduce it, which is great. But it does mean that they have got plenty of rooms to increase their dividend payments. Lastly, I quickly look at their management and ownership. I just like to see, have any of the insiders bought or sold shares in the last 12 months? More insiders selling than buying, which might mean that they don't value their company enough, or have they been buying more? If they've been buying, maybe they see the company as a good value. Board information, so how long has the board been in service? Some of the board employees obviously don't have information towards them, but some of them you'll be able to see how long they've been serving, what their tenure is, which is how many years they've been working for the company as part of that role of the board. And you'll see the average age. Obviously, you want it to be at least 50 odd. You don't want to see like the average age of the board to be 20-year-olds, because what are they going to know? Business-wise, they aren't going to have the same strategy and understanding of companies of that of a 50-year-old, for instance. But then this applies to industry. Perhaps in tech, a younger board might be more useful, but it's good to know. Maybe there's more diversification, so 50 is a good average age to have. You want to see their average tenure as well. Typically, it's just more years you've seen of the average tenure of the members of the board means they're more experienced. And the average tenure is 6.8 years, which suggests a more experienced and competent board with this company. Therefore, in my personal opinion, and purely speculation, I do think Diageo is a buy for the future and a long-term hold for dividend growth payments. And that's why I've added it to my portfolio. Thank you for watching. I'm Osborne Foreman. Have a good night.